Thank you for joining the Everything Money channel. We're glad you're here. Paul and I are talking today about what we think is one of the most important aspects at looking at the fundamentals of a company, and it's their shares outstanding. Paul, as a normal person for years, I couldn't quite figure this out. What do you mean shares, numbers? There are a set number of shares a company has as it creates new owners, part owners of a company. This number, surprise to me, can increase or decrease. There's a lot of variables that go into this. And so we want to go over today in this video what is shares outstanding, why it's important to look at, and what it means if it's going up or down over the years in terms of your ownership of a particular company. And I present to you the man, the myth, Paul Gabriel, the seer of seers. I watched Groundhog Day yesterday.
Did you?
Again, I just had to. I was editing a wedding.
I was going to say you had it on the background.
Yeah. So go ahead, Paul. Tell us about shares outstanding. Why is it a fundamental platform in one of our 8 pillars, which is pillar number 5?
So this is actually probably my favorite pillar. Not that I think it's the most important one. It's my favorite because it's the most overlooked one. People don't look at this, and I call it a silent killer. Why is that?
Dilution would be number 1 to think about?
Dilution is a big thing. It's a way for a company that people don't realize actually hurts them. And here's an example. Let's say a company makes $10 per year. Just to keep it simple, $10 a year. Let's say they have 10 shares outstanding. How much is that per share?
$1.
$10 per share, $10 per year divided by 10 shares, $1 per share. Now let's say they want to acquire a company for $2. They're going to issue 2 more shares. Okay.
Now, how do they do that? They just talk to me like I'm a dummy. They just drum up.
Yes, they just go out there and they create 2 shares. It's part to do with their SEC docs and everything like that.
Okay.
Let's not worry about that. What matters is
they exist.
They can do it.
Okay.
So they issue 2 more shares. The company made $10. Now they have 12 shares outstanding. How much do they make per share now?
80 cents?
83 cents per share. So guys, the same company that made $10 went from 10 shares to 12, and their income per share went from $1 to 83. What this means is you as a shareholder, if you own the company at 10 shares, you now went from owning 1 out of 10 shares to 1 out of 12 shares, because they don't give you a bigger piece of the shares. They're issuing more shares. They're cutting up the pizza pie into more slices. You're getting a smaller piece of the pie for doing nothing. So a lot of people will look at a company and say, oh, look, their revenue and profit's increasing. Well, yeah, but let me ask you this question. If the company went from $10 in profit to 15, but they issued 5 more shares, they still made $1 per share. They went from 10 in 10 shares to $15 of profit in 15 shares. So even though the company's profit went up 50%, your per share amount stayed the same. This is a silent killer. It's a very misunderstood thing because most people think that companies are this is not looking after your every interest. However, some companies do it, and it's a smart thing to do. When is that, Seth?
Well, I was just going to say, this is not to be confused with a stock split.
Completely different.
Yeah, so they're actually creating more shares and selling them off. Now, this is
a stock split. If you have 1 share and they split 2 for 1, you now have a second share. They give you more shares.
Yeah, and then the valuation is pretty much the same.
It's exactly the same.
It just sounds better in terms of an actual retail price of the stock.
Yes.
But in this case, this can be good and bad, Paul. If for a highly inflated stock price, if a company can sell off more shares, they can basically make money selling.
Not making money.
Go on, tell me.
So a company can raise money in 2 different ways: equity or debt. If your company's massively overpriced and people are all about your company and they're willing to pay you a huge premium for it, issue more shares. Why take on the debt? Just issue them more shares. But if a company is undervalued and they're issuing shares, I look at the company saying, what are you doing? You should be buying shares back, because if they buy shares back, they're essentially investing themselves and decreasing the number of shares outstanding. So in the same example, let's say the company went from $10 to $15 per year in profit, but went from 10 shares down to 7 shares. They took their $1 in profit to a little over $2, $2.15, I believe. $2.07, whatever the number is, $2.10. So even though profit went up by 50%, profit per share over doubled. And that's the idea behind it. If a company is overpriced, issue those shares, that's fine. Tesla is an example we're going to give shortly to show these examples. Tesla is massively overpriced. They're going to issue more shares like crazy. What the investors of Tesla don't realize is it's hurting them in 2 ways. They're paid a ton for a company and they're issuing more shares. Now, granted, is that better than issuing debt that everybody's to pay? Sure, it can be. It is usually. But if a company is undervalued, you want them buying their shares back because they're essentially investing in themselves and buying undervalued shares. And that's a good way to unlock some value. A company that might be, their earnings might be the same, not going up. Now, all of a sudden, they go from $10 in profit over 10 shares to $10 in profit over 7 shares. That's $1.40 or so, roughly. So their per share profit went up 40%, even though their profit overall stayed the same. Now, some people might sit there and say it's a manipulation, and sometimes it is because some executives might be paid based on where the stock price goes, and the easiest way to do it is to buy shares back and inflate that per share profit. This is all part of understanding, are the board of directors, is the CEO on your side or not? If they're a very undervalued company, you want them buying those shares back. You want them doing that. They're investing their cash at a high rate of return by buying back their, especially if they're paying a dividend. Let's say they're paying a 4% dividend. When they buy those shares back, they're saving that 4% dividend. They don't have to pay the 4% on that share anymore. They're taking the shares and putting them away. So this is part of the things that people don't realize. A company that is stagnant can do very well for you if they're buying shares back strategically. A company that's overpriced is kind of doing a better job by issuing shares instead of taking on debt and owing it to somebody in the future. Does that make sense?
Should we look at some companies?
Let's look at some companies. So we're going to look at 2 companies today. One that's buying a lot of shares back and one that's issuing a lot of shares. One that's buying a lot of shares back is Apple. So let's look at Apple in the last 10 years. Their revenue has gone from $142 billion to $325 billion.
Jeez.
That's huge. Let's look at their profit, Seth. Their profit has gone from $38 billion to $76 billion. It's doubled in profit. Look at their shares outstanding. 26 billion down to 16.75. So guys, this is like amazing. It's such a big company. How are they going to grow more and more? The way they're going to provide a lot of value to their investors is they doubled their profit and decreased the number of shares by 33%, maybe even more, whatever that number is. That's 40%. That's an insane amount of growth for them. So they're sitting there saying, hey, investors, thank you so much for being with us. We have all this cash flow. We don't know what to do with it because it's so hard to reinvest hundreds of billions of dollars. Instead, we're going to buy shares back and drive up that per share. We're going to give the current investors more and more share of the company by buying our shares back.
If you like the software behind Paul, this is our Everything Money software. We offer it through our Patreon. You can become a Patreon member and get access to this today for a low 80 cents per day.
80 cents per day.
All right.
Now let's look at a company like Tesla.
Tesla, very hype company. You claim it's overpriced. A lot of people would agree with you, but there's still a lot of fandom and hype around this. Of course. And so they love this company, including myself. Hell, I drive one. Go ahead, Paul.
Now their revenue has skyrocketed over 20 times, right? Almost 20 times, 185 million to 36 billion. Their profit, well, had nowhere to go but up. A loss of 300 million to a gain of 1 billion. Their first year of profit in the last 10 years. Look at their shares, guys.
Good boy.
523 million. 524 million and 961 million. And every year they're issuing more and more shares. I don't blame them. Why take on the debt? Just be like, hey, all these morons out here are paying us through the nose to this company. Let's just issue them more shares.
They'll eat it up and love it.
Yeah, they'll eat it up. Of course. I would be doing the exact same thing. Why make your balance sheet worse? Just dilute the heck out of everybody. They love you anyhow. So what does this mean, guys? If they keep on this trajectory and they double their shares again, even if the company makes 10 billion, you're only getting half of that share that you would have gotten had they just kept the shares the same. That's the big thing to remember. It will hurt you in the long run. Now, I understand why Tesla did that. They would rather issue shares at an expensive price, valuation, than issue debt that they're going to owe no matter what. If you're issuing shares at, let's say, for example, your company, it's really worth $50 a share, but it's selling for $100. In my head, if I'm selling 10 shares to raise $1,000, I basically paid $500 for that 1,000 because the stock is really worth $50 a share. That's the way I'm looking at it if I'm the CEO or CFO. I'm not looking at it as I got $1,000. I look at it as I got $1,000 for $500.
Paul, why am I messing around with all this mumbo jumbo if all I really want is to buy a company at X dollars and then hope it goes up X dollars and then sell it so I can make money?
You absolutely can do that. But over the long haul, stocks are a weighing machine. In the short run, they're a voting machine. So in the long run, what matters is the income statement, balance sheet, cash flow statement, what's behind it. And part of that is the shares outstanding. The more and more they buy their shares back, the bigger and bigger the piece of the pie that your share gets. Your share is worth more money. It's a very important factor. The more shares they issue out there, the less your shares are worth because they're getting less and less of the company.
And so final question, how do you take all this into perspective when you're looking at a company and that we look at on this show? When we use our 8 pillars to look at the fundamentals of a company, how much weight do you throw into this step?
This one's more of a, let's see the psychology of the company. Like if I see an overpriced company that's buying shares back, I'd be like, why are they doing that? If I see an underpriced company that's issuing shares, why are they doing that? It's more to understand what is the corporate team thinking about, the executive team. How do they think about the company and the money? Do they think about it as they're owners with me? Or do they think about it as I need to go drive things up and do things? And it's more about the mentality of what the company is doing.
This is a long process. If this sounds new to you, you can join our Patreon. The link is in the description below. You can join. Again, I say this in a lot of videos. I felt very alone in my investing journey. It was like me talking to my wife and doing research on YouTube and reading news articles. But you can join a community, our Patreon. You can get in and talk to people literally all over the world to further your mindset about having this discipline, looking at these fundamentals of companies. If this speaks to you, we'd be glad to have you on our team and working with us. So, Paul, that's our take on shares outstanding. We appreciate you guys watching, and we'll certainly update this, talk more about this in the future. An incredible, one of our 8 pillars and a very important step in looking at a company. So, tickle the thumbs up on the way out. Thanks for watching. See you guys.